Hello everybody, Michael Silva here. Is this the turning point for the stock market? We're going to be discussing that on today's Stock Market Brief Show. If you were paying attention intraday, you saw some wild, crazy price action. And this came on the news of, well, starting off the day with higher than expected GDP, and we had a Meta with strong earnings. You can see Meta earnings after hours, we went all the way up to 330, which was beyond its expected move there, breaking out of its expected move, but then started coming back in. We had GDP come in at 2.4% versus the 1.8% consensus. So you might be wondering, well, what went wrong? Why did the market all of a sudden turn back around? Well, there was news released from the BOJ to discuss a yield curve control tweak that'll allow rates over 0.5%. Now, this is almost seems like they were just leaking, like the news came out, but the decision hasn't fully been made yet. That's going to be coming out at 10:30 p.m. Eastern Standard Time today to 12:30 a.m. Eastern Standard Time today, according to a few reports. Now, when this news dropped, you can see the SPY, boom, took down to the downside. Where you look over here at the Japanese yen, this thing fired off like a rocket ship. The 10-year yield started to rise rapidly too as well. You can see it's up 4.18%, reaching back in to 4% territory. You might be wondering why this matters. Jim Bianco on Twitter did answer this question, stating that Japan is the largest foreign holder of the treasuries, even larger than China. Raising the cap makes the JGBs relatively more attractive than UST. So in theory, this should sap demand for UST2 JGBs. He said to sum it all up on that thread that he put together, in sum, treasury yields are looking less attractive for the largest foreign buyer. Commodities are surging, gas prices are popping higher, the economy is beating, and it looks like more growth and not recession for jobs. Bond yields are responding appropriately. So yes, all 11 sectors that make up the S&P 500, the only one up on the day was XLC, up 8.84%. Relatively unchanged on the day overall on the index products if you're just looking across the board at this number, but there was obviously a lot of intraday action. If we take a look at what the dollar did, the dollar was also up greatly on the day. Now, this is going to be an important one to watch because we've been seeing a very strong correlation, right, with the dollar. When the dollar topped out here in October, the market bottomed, right? And the dollar head down, S&P 500 goes up. And now what you're seeing here is we did break down from this level, made this little U-turn, kind of back tested it today, and we're starting to pop higher. That's one way of potentially looking at it. Or you can potentially look at this as, you know, potentially something like this, where we coiled up, we broke down, we're coming to back test it, this 102 area, and then if the dollar starts heading back down, that could make the S&P 500 go test the all-time highs. Now, if we take a look at the intraday chart, this is a very rare thing to see happen, but you can see we gapped way above the expected move for the day, and outside of the the weekly expected move, we came back in, we retagged it, and then we started really selling off. Where? To right underneath the lower daily expected move. The same thing took place on the Qs. We came up outside about a 2 sigma move, outside of the daily expected move. We tagged the upper weekly expected move pretty much to perfection. And then we started breaking down through, but not quite making it all the way to the lower daily expected move, but did fill the daily gap. So we were up, 1.5% or so, right around there, potentially even more on an intraday basis, going to 384 and falling all the way down to around 376. So a lot of volatility, which we've been preparing for this week. Now, what does this create on the chart? This creates what's known as a bearish engulfing candle or a bearish outside trading day. The name does not really matter. What you need to understand is that it could have potential turning points. It could present itself potential turning points in the market. Now, if I take a look here, you can see that the body, we gapped up. Okay, the high of the day is also above the high of all the prior trading days within this chart. And then we closed down beneath this body, this body, this body. I mean, not quite this one, but we engulfed multiple trading days here, which could be potentially bearish. And why is that bearish? Well, let's walk you through kind of the 2-bar reversal combinations here really quick, just to get a good idea of like, hey, is it a strong signal? Is it a weak signal? Well, I'll tell you what it is from a 2-bar perspective, okay? First, what you'll notice here is we have a couple different 2-bar reversal patterns, but what you'll notice on the sides, you don't even need to worry about the names. You typically have, a strong day. We start with a gap up and we close right on the day. And what you'll notice the difference as we move down is they get more aggressive. So this one right here, dark cloud coverage, gets through the thrust line, which is 50% prior to the buyer prior body. This is where we landed. We engulfed the entire body of the prior trading day. Okay, and then even more bearish than that is what's known as separating lines, is where we close up here and then we gap down way down through here and we close red on the day. If you could see that right here, this is kind of how it works as far as authority, as far as the 2-bar candle. So if the chart's going up, think of it as going up, then you get a strong green day, then you get this inside day. This is really just considered consolidation for the most part, but as we go out, you'll notice, okay, this could potentially be bearish as we're gapping up and closing a little. Up, we gapped and we closed at matching highs. Up, now we're starting to thrust through the body. Then we're getting through that dark cloud coverage. Then we're engulfing. Then we're separating lines. So that's the progression. Each one of these has its own candlestick name. It's unimportant. All you need to do is just watch, like, it gets more bearish as the candle gets more authoritative from the downside. Now, this is important to note because why? Well, it could potentially mark a turning point in the market. And I'll tell you what we need to see in order to unconfirm that and to confirm that. Okay? But what I want you to pay attention to is how could this potentially be important from a bullish perspective? Well, look at here at the October bottom. We got macro news that day. We gapped way down, but we closed darn near at the highs. So the chart was moving down. Big authoritative day to the downside to the open. Big authoritative move to the upside. Bam, we haven't ever tested the low of that day. We saw the next day, it came back within it. We gapped back up, and then that's when price action started moving. Okay, that's not to say the same thing's going to be happening here in reverse. Remember, right, the BOJ hasn't even made its decision yet that created all of this price action, which started off to be a good day in the first place. Okay, so there's going to be a lot more volatility, obviously, as we move forward. But if I show you the 2-bar reversal from a bullish perspective, it's the same exact thing, how you can gap down and close up a little bit, gap down and close through the middle, the piercing pattern line, right? The 50 point. This is basically dark cloud coverage, but it's called a piercing pattern. So it's just the opposite, right? Then we engulfed, and then we have those separating lines right there. And then the same thing goes, whereas if the chart's moving down, right, boom, and then we get these candle bar reversals, this is more consolidation, but then you start to see where you gap down and close green, how the candle starts moving through it even more aggressively. So just there in that October bottom, we had a very same situation, same type of candle. Okay, but that's not to say that we're going to just all of a sudden, that's the top and we're going to head straight back down. So we need to be more tactical than that, and that's why we use expected moves. Expected moves on the weekly time frame, you can see how the S&P 500, we tagged that upper weekly expected move, and we're basically unchanged on the week to slightly up. Okay, so as it stands right now, from a weekly perspective, nothing's really going on. It was just a lot of intraday volatility. So if you want to be more bullish, we really need and want this to just kind of deconfirm itself, like it doesn't count, it doesn't matter anymore. We need to get back above this high. Okay, that's what we need to do. Now, if it's going to confirm itself to be bearish, you'd see a daily close under this level here. Now, if we start closing down within this level, like tomorrow's the last trading day, but it could potentially, if we get more weakness, open the door to the lower weekly expected move. To see it go from the upper daily down to the lower weekly would be quite an aggressive shot. Okay, and just like we saw with this October bottom over here, even this candle, right, this big bullish candle, we gapped up, everyone's like, here it is, and then it closed way down here, it scared people out, and then we gapped way back up. So if we get similar type price action, I would imagine that the price can potentially come right back up into this area. Doesn't necessarily mean that the fear has to be out, but we need to really reclaim the high of that candle to kind of put that bearish engulfing candle to rest. Okay. Now, if I'm taking a look at the NASDAQ summation index, it is starting to curl itself over some more. So if this starts ticking over, that could identify a potential change in trend. So that's another thing we look at. We also look at the summation index for the NYSE, and you can see that this ticked down a little bit, but we've still been bullish from this point. And if you go straight up, that's when it identified a potential change in trend, and we've been going up. Now, if you remember, I've been talking about the divergence building in the NYSE McClellan oscillator, and you can see price action was going up, the internals were weakening, and this has played out multiple times and has just been a very good, helpful indicator to potentially just throw caution out there for when we might potentially see some increased volatility to the downside potentially, or just see some more wild and wacky moves. And as you can see, we kind of pushed a little bit higher, but then we closed pretty bearish on the day. So is this divergence playing out as it crosses back beneath zero? Do we have more sell side? I'm not too sure, but as you can see, we did have that down day today. Going into tomorrow, we also have some more data. We got core PCE, we have personal spending month over month, and personal income month over month. I got a whole host of other stuff there too as well. Not to mention, or don't want to forget to mention, before the open, we have Exxon, PG, Procter & Gamble, Chevron. We have a couple other names, but those are some of the bigger ones right there that we'll be reporting before the market opens. I also want to just point out that we've been talking about the monthly expected moves, how we're getting to the top area of those, and we tagged them, got outside a little bit, okay, but now we're kind of coming back within. The Qs, same situation, we were just getting to the upper end, and now we're pulling back in there, but still overall, it's just been in a monster move right there for the NASDAQ 100s. And then IWM, we got outside of it, but we're kind of fluttering right by it. Now, if people think that this is really, the next bull market, like this is the bull market, like we're going to all-time highs, then I would say IWM, Russell 2000, would be an opportunity there. Now, this is typically a better barometer on the overall economy because they're smaller businesses. But as it stands right now, we're still about 18% off the all-time high. And we're just now getting out of that red shaded zone, which happens to be 20%, okay, which is considered a bear market from peak to the minus 20%. We do have the price percent oscillator starting to flip over. So maybe if we get a little bit more bearishness, okay, cool. We've talked about this on the daily charts, but the 5-day moving average, if we can hold, the 5 monthly moving average EMA, if we can hold that area, and even if we pull back, this could potentially create a great opportunity if we see price strengthen up, and then we could start to push out of this tight consolidation. So that could be a potential opportunity with IWM if you want to play it to the upside. Just remember to obviously manage risk as you see fit. Now, if I take a look at the SPYs, we're going to go over the new daily expected moves. You can see up here, boom, this is where we tag the upper weekly expected move. This is the 15-minute time frame, right? 5-day moving average, we were holding, we broke. Okay, so what does this mean? The longer we stay under the 5-day moving average, the more it's going to flatten out to curl over. That is bearish. That creates a bearish trend just looking at that simple moving average. We're below the week-to-date anchored VWAP, okay? So that means the average buyer based off of, price and volume is underwater after today's trading session. The green line beneath us is the quarter-to-date anchored VWAP, and I want you to remember that because that has been an important level for the Qs. So the lower daily is 449.09. So if we come down here tomorrow, be aware that it's also in confluence with the quarter to date, and this could potentially create opportunities to trade intraday. What you would do is simply go into a smaller time frame and then see if price can put in some higher lows, boom, and start bouncing from those areas. And then you can make for a quick scalp trade. As it stands right now, we have a little positive divergence on the RSI, so to see a bounce back up to the week-to-date anchored VWAP, it's more than likely, but understand if this starts coming down, 5 days here, we start bouncing up, everyone's like, aha, hooray, right? Maybe even come up to here. Well, remember, if price breaks down through and creates lower highs, that could still be very bearish where we start heading down later, okay? So it presents itself to be an area, just a time to be caution. Obviously, there's a lot of volatility, so you want to see how price firms up, right? Price can just go like this, right? And then we create a potential bear flag. Then that's the pull, that's the flag, then boom, it takes down for the following week. We don't know, okay? So if you want to play this from the long perspective, it depends really where we open up. But say if we open up here, see if price bases out a little bit out of the gate, maybe creates like a, what's it called? It's called a opening range. So say, for example, you trade on the 5-minute chart. Well, wait for 30 minutes to go by. That creates an opening range. You take the high of the opening 30 minutes, the low of the 30 minutes, and then you can see if you get a 5-minute bar candle close above it or close below it, and that could potentially create a trend down or potentially a trend up if we're going to be having a potential trend day. So that'd be something that I'd be paying attention to early on in the trading session, given the volatility that we're currently seeing right now. If I take a look at the Qs, now this is why I said remember the quarter to date anchored VWAP, we're still doodling right here on the quarter to date, right? So all the buyers based off of the time, the start of the quarter, right, which is this month. We still got plenty of time left in this quarter, right? Yeah, January, February, March, April, May, June. Yeah, so this is the first month of this quarter, and we close right above it. So we're right at it. We're just doodling at it. Now, the more times that this is tested, just be careful if this thing starts to really break down, because like I stated yesterday, it could really change the sentiment of the average buyer this quarter, right? If they've been feeling good and confident all quarter, but then all of a sudden the average starts to get underwater, well, that can create pressure. Think of yourself in a trade, okay? I want you to really think about this. So if you are playing a breakout and price is coming up to this level, boom, 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 things are tightening up right here, and you buy it right here, and you're like, bam, we broke out. And then it's like doing really good, and you're like, ah, sweet. Yeah, no, I'm good now. I'm going to just probably look to add in. So it's pulling back. You're like, all right, cool. Flagged again, I'll buy in again, I'll buy on some more strength, oh cool. And then it comes down, you're like, oh no, now I'm underwater here, but hey, I'm still above this area. Okay, this was my average buy price, and now it's coming down. Now, if it comes down to break even, after you saw all your gains up here, right now you're probably thinking, oh man, I'm getting nervous. Like I saw all those gains, is it gonna come back? Is it not gonna come back? Well, imagine if your average starts going under, and you're like, well, shoot, I was up this much. I don't want this to turn into a big loser, but I know my original stop was down here, and I was thinking about moving it up, but now is it too late to do that? I don't know. And then all of a sudden it starts pressing further, and you're like, all right, this is just annoying. I'm getting out. Boom, okay? And that's what typically happens from a psychological standpoint. That's why it's always very important to manage risk, but that's what I'm saying is how potentially the average buyer based off of volume feels right here at this line if it starts breaking down. If it starts breaking down, look for potential back tests and look for the back test to actually hold, because then you could potentially create those lower highs and lower lows, creating opportunities for shorts if you know how to tactically do shorting. I'm not really a big proponent on shorting or advocating for it, but if you know how to do it, awesome, great. That's all I got for you on today's episode, everybody. See you later.